Welcome to the Treasury Update Podcast, presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in.
Welcome to the Treasury Update Podcast. This is Craig Jeffrey, your host today for our episode titled Counterparty Risk Management. This is a really key topic, and I'm really excited to be here talking with Steven Peterson from Chick-fil-A. Welcome to the Treasury Update Podcast, Steven.
Glad to be here, Craig.
And we're live. We're sitting across the table. We've got lights on us, even though it's just a podcast, but it feels professional that we're doing that. But let me just give a quick overview before we get into the topic. With FDIC actions against several large banks in the U.S., this really created that short-lived scare in the markets. No depositor lost money. From what we're seeing as we analyze and ask companies, only about 30% of companies, these are commercial clients, large corporations, are formally monitoring counterparty risk on a regular and consistent basis. And I must say that's concerning to me. I think it's troubling in any environment, but particularly after something's happened, the formality of that should be different. But that's just my view, my opinion. So I'm really excited to talk to you about this, Steven. So maybe we can begin. You could give a bit of an overview about how you're looking at operational and investment exposures, perhaps focusing on the shorter end, so cash, short-term investments as opposed to long-term asset management or other parts of the balance sheet, but focus on the shorter end of cash and investments.
That's a great question, Craig. And again, appreciate you for having me here today. Yeah, from a historical perspective, the banking industry has always been perceived as very safe and reliable. What happened earlier in the year with SVB, First Republic, and Signature Bank was a wake-up call to Treasury teams. There are teams that, today that don't have people who were here during the 07, 08 financial crisis. And then remember the number of banks that failed and that the negative impact it had not only on businesses and consumers. It personally impacted me because I had invested in a small local bank here before the 07, 08 period. And that bank eventually went insolvent. And I lost my entire investment. So it was a lesson learned and one that I'll never forget. But from our perspective, we evaluate banks from both a cash management and a short-term investment standpoint. We look at are banks in the camp of too big to fail, or is there a risk that an event that could cause them to be insolvent and for us not to be able to pay, our vendors and suppliers or even make payroll? That is business contingency 101, and why you just don't have one banking partner. You have to have kind of an insurance policy because you can't open a bank account overnight, as we both know. It takes a long time. So you have to have that insurance policy. You have to be able to monitor your banks, the risk, and their financial health.
From a diversification standpoint, back around 2008, 2009, many organizations had a primary, secondary, sometimes they had a tertiary bank that would handle operational activity. And everyone sort of has moved to, let's be more efficient and consolidate, which is a risk. And so what you're talking about is getting back to the basics of diversification there. When you say too big to fail, I know we're going to talk about systemically important banks, but the systemically important bank is sometimes there's a view that central banks aren't going to let those go under. And so there's a sense of additional safety, which I don't know if you had any comments about that, but certainly that's playing out in the market where money moved when things happened with SVB, First Republic, and others. There was a movement towards larger banks and to banks that didn't have a huge amount of uninsured deposits. But yeah, I'll let you get back to it. That was some good history too.
Yeah, no, thank you. From our perspective, when things happened in March, when we took a really deep dive into, both our larger banks and even our regional banks to ensure, their financial health was stable, and that we, from an investment perspective, we continue to invest deposits and invest in government money market funds with these banks. I'm glad to say we felt comfortable with all of our banking partners. And to kind of go back to, on this short-term investment side, we need to be cognizant of the FDIC, $250,000 insurance. But, as corporations, it's hard to have only $250,000 in bank accounts for major corporations. And you'd have to open up a lot of bank accounts. And right now, Treasury Treasury's resources are very constrained, and you just don't have the capacity to manage a lot of bank accounts. And for myself, I would not want to do a lot of all that KYC paperwork either to manage all those accounts. So, so very important for us to make sure the financial health of our banks are stable and are in line with what we expect, given where our investments are.
Tying back to the operational side, you talked about payroll. Silicon Valley Bank, $42 billion moved out of it on Thursday. People wired, and they would have wired out more if they could, right? They didn't have access. That weekend was really a disconcerting weekend for many people. If you were at the bank, of course, the displacement that you had of your job was your employer was going to be impacted. You were going to be acquired by someone else. And there's been some positive things after that in terms of what's going on, but it certainly displaced a lot of people. But the number of companies that were like, how am I going to make payroll? How am I going to make payroll that week? Not only how am I going to pay my vendors that I owe? And so that was a pretty exciting weekend. And that points to the need of what you're saying. And before we get back into like, how are you managing and monitoring banks, formally, maybe you just give us a quick overview of Chick-fil-A. I know we have 4 Chick-fil-A stores in our town. So I know about them, but there's people that are in geographies that may not have them and not understand. And then maybe just go over your role at Chick-fil-A.
Yeah, no, everybody loves Chick-fil-A around here, Craig. We're in kind of the hot spot of Chick-fil-A. Our corporate office is close. It's just south of Atlanta near the airport. So Chick-fil-A is a family-owned, privately held restaurant company. It was founded in 1967 by Truett Cathy. We are known for our signature hospitality and our freshly prepared food. I might be a little biased, but I think that our chicken sandwich is number one and tastes the best out of everybody. So, but again, I'm a little biased.
What do you do at Chick-fil-A?
So at Chick-fil-A, my role is I lead the Treasury Department. And I've been working for the company for 10 years now, and all in Treasury. And I've been in Treasury my whole career. I've previously worked at 2 Fortune 500 companies based here in Atlanta. Very thrilled to be at Chick-fil-A. A lot of exciting growth. We expanded internationally a couple of years ago into Canada. We also have stores in Puerto Rico, and just a lot of growth domestically for Chick-fil-A. So again, really blessed to be at the company at this point in time.
Well, thanks for that background, Steven, on Chick-fil-A and what you do there. But back to our topic about counterparty risk management. So how are you managing and monitoring the banks? You talked a little bit about that extra hard look, like everyone was doing back in the March timeframe. So how are you monitoring banks? What are you doing?
Yeah, so Craig, today we're monitoring news sources and news channels. We live in a social media society where news hits the wires pretty quickly. So we have some things tailored to say, hey, if something comes up on the news wire about one of our banks, we're taking a look at it, whether it's good or bad. So that's first what we're doing on a daily basis. Secondly, we're regularly looking at credit default spreads of our banks to ensure we don't see any significant movements in their levels. I feel like this is a really good indicator on how the market evaluates the risk of a certain bank. This was definitely something that people monitored back in the 07-08 crisis, and it was a really good leading indicator if a bank was perceived to be in financial trouble.
Early, like very soon to the trouble, right?
Right, very soon.
Not months ahead of time, but
yeah.
At the end, right? It was water. It was almost the water cooler talk.
It was. Yeah.
So you're looking at the change in the spreads. Are you also looking at the volume of trade activity there?
We do. Yeah.
Okay.
We also monitor that as well. We also do on a quarterly basis a bank risk dashboard. And very excited about when we put this together. And this was actually put together before what happened in March. So I like to think we were ahead of the game here. Because again, I was in the Treasury Department at another corporation during 07-08, and this would have been very valuable information then. So when I came to Chick-fil-A, I was like, hey, we need to evaluate and monitor the bank's financial health. So in this dashboard, we have a couple things going on. We first look at any movement in long-term credit ratings by any of the major rating agencies. We look for who's been put on watch or who has been downgraded. We also monitor the Tier 1 leverage ratio, which looks at Tier 1 capital over assets. And, Tier 1 capital refers to those assets that can be easily liquidated if the bank needed the capital in event of a crisis. The higher the Tier 1 ratio, the higher the likelihood a bank could withstand a negative shock of its balance sheet. So we feel that ratio for us is really important. It's like, what's the level currently and what has been the trend? We also measure non-performing assets. We evaluate to see if there's been a negative trend, quarter over quarter, year over year, of these non-performing assets. And there could be different reasons that these non-performing assets are increasing. Could be bad loan decisions being made by the lender, or it could just be the economic environment. People could be defaulting on their loans or late on their payments just because of the economic environment. So,
are you looking at differences between, like, if it's coming from commercial real estate, for example, or defaults on consumer cards, or you're just looking across the board?
We're just looking across the board. We just look at the number itself. I mean, if we really want to dig down deep, if we saw a number that was very concerning, we would probably dig a little bit deeper. But we really haven't seen one, lately within our bank group. So we really haven't dug a little deeper.
So this bank risk dashboard that you run, this is, I know you guys are big with business intelligence tools and running these things. Is this run and supported by the Treasury Group? Is there a lot of automated input into this, as well as some manual feeds, or what?
Yeah, great question. Yeah, we produced the dashboard in Tableau, and we aggregate information from different sources. Some of them is financial software. Some of them were looking on the internet. Some of them were looking through financial statements, and a couple other things that we have included on the bank risk dashboard is we also look at the short interest as a percentage of the bank's equity flow. This is also a good indicator if the market is pessimistic about a particular bank or industry. And then we also just monitor the stock price. Because again, I mean, if you want a real-time evaluation of what the market's perception on a bank or any particular industry, look at their stock price. So we're looking at those trends and making sure, we haven't seen anything, that's concerning to us. So that's kind of, what our Treasury dashboard looks. I mean, some of it we can monitor real time. Some of it is just quarterly or annual information that we receive.
So you're looking at stock price, stock trading volume, and those are examples of it creates some kind of flag that you then dig deeper if need be. They're just potential ways to get an earlier look at things.
Yeah, it's almost like an early warning system. It's like, okay, yeah, there's something going on there. Let's check underneath the hood and dig a little deeper. And then, too, again, with our relationships with our banks, we can always go back and ask them and say, hey, we're looking at these numbers. Kind of help talk us through these. What are we seeing? Do you feel like, hey, this is just a season for you guys and you're going to pull out of this? So again, having a good relationship with the banks, with your relationship manager really helps.
So, back in March, one of the big items that people were looking at was the level of uninsured deposits, and that's not something that's available moment by moment. So is that something you monitor on a quarterly basis as just one of the many factors? Or maybe the better question is, you talked about tier one capital over and assets as a key factor that you look at. What are the measurements that you prioritize over others? Maybe that's a simpler way to ask that.
Yeah. I mean, we look at them all. And to be honest, I mean, we really don't prioritize any one over the other. I think every one of those indicators tells us something different. But if I had to pick one, it'd probably be the tier one capital over assets, because that really is something that the Fed is also, looking at and reviewing. And it's really important to the banks. When we talk to them, it's like something they're focused on. I mean, stock prices, the movement in stock price could be, related to just the movement of the overall market. Could not be something that's particular to that industry or to that bank, but it could just be a function of a down market. So we really think like, the tier one capital over assets and non-performing loans are really the key indicators for us to, again, if we see, a concern there, to dig a little deeper.
So you're looking for things that are outside the norm and outside perhaps certain parameters. If it falls outside a range, you want to be digging into it. Maybe you make a move. Or if it falls, the market's down 7%, but this one bank's down 20%. That's outside the range. And so you dig into those more. Is that?
Yeah. We look at absolute numbers. We also look at trends. Because I mean, really, anybody can have a bad quarter, bad number, but we really are focused on the trends. Is this a trend that we feel is very concerning, or do we feel like, hey, it's something they can climb out of? So again, we're focused both on the absolute number and the trend.
One of the questions I had that I was going to ask you before, you sort of covered it in the beginning, or you did cover it earlier. Maybe there's something you want to add. It's, we talked about systemically important banks, or banks that are too big to fail because they're systemic impact across the overall economy. They're not going to let it fail because of the cascading effect. How is that impacting any practices? Is there anything else where there's an impact beyond what you had said, at the beginning of the discussion?
Yeah, for us, we definitely feel a little bit more comfortable if our banks are implied to be too big to fail, because we feel like hopefully, the FDIC came in March and guaranteed 100% of the deposits at SVB. So we feel like, hey, if one of our banks that was systematically important or too big to fail were to have an event, that the FDIC would come in and help ensure those deposits were covered. But that was in March. We both know that it's nothing is guaranteed.
Right. Just because a bank is identified as systemically important, that doesn't mean that there won't be some losses if there's some potential. And I'm trying to be calm in all the discussions, but that really is a factor in some of the discussions. Certainly, right. We've spent more time talking about banks. You have a lot of suppliers. The discussion about supply chain resiliency was extremely heavy at the beginning of COVID, right? Because there was disruptions. Are you doing anything monitoring suppliers, for example? What are you doing with suppliers? Is that factoring into your counterparty risk management?
Yeah, that's a great question, Craig. So yeah, definitely we are evaluating our vendors and suppliers at, their financial health, because it's important at Chick-fil-A. I mean, it's important, we are able to ship waffle fries, we are able to ship chicken to our operators. So just a few years ago, we put together a more formalized approach to kind of evaluating the financial health of our vendors and suppliers. It's more about enhancing our business continuity, as no one likes to be surprised, especially from a negative perspective. During the pandemic, everybody was concerned about themselves, about their liquidity position, but everybody was really very concerned about their suppliers and vendors and their financial health and their liquidity position, because they could have been impacted, significantly different than our corporation, than Chick-fil-A. When we look at evaluating our vendors and suppliers, there's a few criteria that are important to us. Annual spend, that scale, whether it's, we spend $10,000 with this vendor or supplier per year, or we spend, $100 million. That matters to us. And number two is the ability to replace a vendor if they enter financial distress. How easy is it to replace this vendor? Is it a vendor that, took us a year to source, or was it a vendor that took us 2 weeks to source? So that really has to be one of the factors in the decision. And number three, which I think is most important, is, critically and potentially, and their potential impact to our franchisees. I always use the example as, if you have toothpicks and chicken, and the toothpick vendor, goes bankrupt, we can go buy toothpicks somewhere else. There's always Costco, Sam's, Walmart. If a chicken vendor goes bankrupt, that's a different story. That's a material impact to our franchisees and our business. So when we look at, okay, what's the potential impact to our franchisees? Is it material? Is it significant? That is probably the driving factor, along with those other two I mentioned, that, makes us look at and evaluate, whether we do a full-blown evaluation analysis or we do kind of a quick credits check on our vendors and suppliers.
Are you using the same monitoring dashboard, just broken out differently, or is that a different way of evaluating those type of counterparties?
Yeah, actually, it's a different way. We do leverage a couple of different financial software tools to perform our analysis. We get, audited financials. Whether a company's public, it's a little bit easier to get access to these financials. And if they're private, it's a little bit more tedious. But we're able to, hopefully get that information in, run it through these tools. And then the tool kind of provides us a overall credit health score that we use to, inform our departments, or the partners we're working with inside the company.
As we wrap up this discussion on counterparty risk management, what guidance would you give to others who maybe they need to move away from being informal in this process, responding to a headline, and perhaps being more diligent, more formal in managing counterparty risk? What would you say?
Yeah, the couple things I'd say, counterparty risk is real. And I would say don't fall asleep on monitoring and evaluating the financial health of your banks. It's too important to ignore. Your liquidity depends on it. The banks are doing their due diligence on your company. So why don't you do the due diligence on them as well? And don't think you have to come out of the gate with elaborate process or system. You could really start small. I talked about just looking at the news feeds, seeing if there's any headlines that come through about your bank. You click credit default spreads. Those are, relatively easy to find. Start small and just continue to expand your monitoring and your evaluation. But just at least do something, and there might be some seasons where you have to do an evaluation or you're monitoring on a daily basis. And there might be like in March, but there might be some seasons where, hey, a quarterly dashboard will work.
Yeah, that makes sense. We're seeing, we probably see more follow-up. I think we get contacted by our customers, every week about different things. It's more of it's is not on the financial supply chain, but on the IT security. They'll ask about the network. So people are concerned about the financial health as well as the digital health of companies. And those are, I'd say that's a little more mature in the process. It's like you get automated mailings anytime there's some event, some CVE comes out. Do you have exposure to this here or there on the tech side? So it's really good to hear you describe on the financial side. And that formality is really important. So I'm so glad you talked about that and shared what you're doing at Chick-fil-A. Thanks so much for coming in.
Yeah, appreciate the invite, Craig.
You've reached the end of another episode of the Treasury Update Podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.